Welcome back to another coffee break. I'm your host today, the coach behind the clipboard, Nic Yeomans, and today with me I've got Randy Yeomans. Randy, welcome.
Thank you.
And we're going to have a great conversation today. Today we're going to break down 5 topics: inflation, Federal Reserve and interest rates, real estate. We're going to talk about global and domestic energy policy and concerns we have around there. And where do we see opportunity today? Again, today we're going to be to the point. So we're going to have a great, quick conversation, but we're especially excited. We've got a special guest, Randy. Yeah. We have invited Merit Financial Advisors Chief Investment Officer Brian Andrews to join us, and he's going to come in and he's going to participate in our conversation. Really looking forward to having him participate with his insights. And, he does a lot of these, and he is constantly educating and updating, which I know our audience really appreciates that educational approach and insight, behind the talking heads on TV, like what's really happening, right?
Yeah. I mean, because there's no advertisement going on, so you don't have to promote something or another. It's really good. And I don't know how many people are watching the videos that are being put out, but they're really good. And I think it's a great addition to our team.
Yeah, for sure. So with that, we'd like to welcome Mr. Brian Andrews.
Brian, welcome. Thanks for having me.
Yeah.
Great to see you.
Yeah, good to see you. Now, Brian, where are you coming in from today?
I'm actually coming in from Milwaukee, Wisconsin.
Okay.
My home.
Yeah. Well, I'm sure your weather might be a little bit more pleasant than the deep south right now.
Oh, absolutely. Yeah. A little cooler.
Yeah, a little cooler. Well, guys, to kind of kick off the conversation today, everybody is paying attention to inflation. We have to pay attention to it. And you've got retirees who are on fixed incomes. They're getting clobbered in so many areas still. Now, the July inflation numbers, we had 3.4%. Core inflation was lower at 2.5%. Energy rose at 14.7%. And at the end of the day, people are still having to pay a whole lot more money over the last couple of years. So, Brian, I'd like to go ahead and start with you. What are some of your general observations with inflation right now, and what are some of your concerns?
Yeah, it's a great place to start the conversation because, like you said, I think people feel higher prices whether they go to the gas pump or the grocery store. So we all know that prices are rising, and we know that the level of inflation is tied to the level of interest rates. And so interest rates kind of drive the cost of money for you and I. For people trying to buy a house, for companies trying to borrow money. So those two things are interrelated, and it's really important to start there, I think. And I think what we're seeing is persistent inflation above the level that the Federal Reserve would like. They target 2%. And as you just said, in July, the number was over 3%. This morning, their preferred measure of inflation was still over 3%. So a long way from their target. And I think what that means is we're not likely to see interest rates on the lower end, shorter end of the curve come down too quickly.
And I think that's really interesting. It ties into, Randy, your and my recent conversation, because we were talking about, we're starting to see economic growth slow down, but, you were also talking about interest rates and how we're seeing some change there. So, what are some of your general concerns around inflation right now?
Well, I think the big thing is that inflation is very different from one group of people to another. So inflation tends to reward people who have assets. Assets can appreciate. And so if you already own assets, inflation has some different kind of impact on you, perhaps, than people who are starting out right now, who are trying to purchase and accumulate assets. So I think there's definitely a division among where you might be in life with inflation. And of course, when I think of inflation, I'm a little calloused because when I first witnessed real inflation was in the early 80s, and I bought my first home at about 18.5% interest. And the inflation impact of that was that 5 years later, I sold that home for twice what I paid for it. So there's a real interesting correlation between inflation and appreciation of assets. And I totally get what Brian's saying, because when you think about it, where we want to lower rates, the impact of lowering rates isn't necessarily going to have the same impact on the economy that people think it will have.
Yeah. Well, and, on the topic of rates, thinking about the Federal Reserve today, I was helping my daughter study for an AP exam in microeconomics last night.
Good luck.
Yeah. Right. I was like, I haven't looked at some of this stuff in, 25, 30 years. I don't know, a long time.
This is called fake it till you make it.
Oh, there might have been some Googling happening while I was helping her. But, it was interesting because last night's topic, we were talking about the Federal Reserve. We were talking about the Board of Governors and how that works out, et cetera. But the Federal Reserve, we were talking about, monetary policy and how they do set monetary policy in place. Well, so they held their target in July, 3.5 to 3.75%. Brian, we were just talking about some of their observations. What is it, as a takeaway today, as we think about the Federal Reserve, in removing, the president and the political pressures that might come sometimes with the Federal Reserve, what are we looking for them to say that might alleviate a little bit of the pressure? Because interest rates, while historically they are normalizing somewhat, they still do feel high, especially when we think about the last decade. So, Brian?
Yeah, that's a great question, particularly because we have a new Fed chairman, Kevin Warsh, and he's been pretty vocal prior to becoming chairman and since becoming chairman that he doesn't like the idea of giving too much information to the markets and to investors, which I'm sure most people are still not comfortable with. But I think the important thing to think about, you mentioned earlier the fact that economic growth is slowing down. So we're talking about slower growth and higher inflation, or at least higher than their target. And I think it's interesting because it creates sort of this natural tension between growth and inflation that the Fed actually can benefit from, meaning that they can just keep rates where they are and be able to continue to watch the data or the information flow regarding how the economy is performing. And so we may not see much of a change in short-term interest rates between now and the end of the year, as an example.
Yeah, and to your point, they might, especially with the tariffs over the last year, which are historically inflationary, the market was running pretty hot there for a while, but inflation, had kicked into high gear, and they might, like resting, as you're saying, kind of letting things stabilize even more. There's always this feeling like you should take action, but maybe sometimes the best action is no action, in that decision, right?
Probably in a lot of areas, that's true.
Yeah.
Trying to fix a problem can be the worst thing that you can do.
Yeah. Well, in thinking about even your 18.5% interest rate, on your first home, let's pivot to real estate for a second.
Yeah.
Because, back in the 80s, I remember you always talking about, clients' biggest assets in the 80s was, their real estate, right? And then we've pivoted in middle-class America, the middle-class millionaires out there, their biggest assets became their 401ks, their IRAs, their retirement plans. And, with the recent boom in real estate that we saw, real estate started competing with those retirement account balances again. But I am concerned that we're really kind of pivoting to more of a buyer's market. Now, I don't think it's truly, a buyer's market yet, but I think we are trending that way because, and I think buyers are having more and more negotiation because inventory's up. I just looked at these numbers, right now, nationally, housing becoming more buyer friendly. 4.6 months is the average inventory that is, on the market. Historical average is 6 months. So we are seeing it again trend more and more inventory that way. Georgia is, even closer to that 6 months at 5.2 months. So we are seeing an increase in time that homes are sitting on the market, which again, buyers have a little bit more negotiation room here. So I think a lot of this is gleaning. I mean, how do you motivate somebody who's in a 3% interest rate like I have today to go ahead and accept a 7% or 6.5% interest rate? So, Randy, what's your? I mean, obviously you were 18.5% in the 1980s. Your home doubled in 5 years, but with inflation kind of cooling off, interest rates are still high. What's going to get this real estate market moving?
Yeah, it's kind of interesting because I wondered how he's going to make those payments. And now I know my electric bill's about the same as what my house payment was back then. That's a good example of inflation. I think one of the interesting things that, people have their wish list, I wish interest rates would go down and that would make housing more affordable. But on the other side of it, what would happen to inventory and what would happen to the price of a home if a home became more affordable because of lower interest rates? So there's a lot of moving parts in this that I think a lot of times haven't been fully thought through. And the Fed really has a difficult job. Really trying to balance between those things. And again, it emphasized what I started with. If you own real estate, whether your home's paid for, whether you've got a mortgage right now, likely that if you bought a home within the last 10 years, you've got an interest rate that is really low, which means those homes probably aren't going back on the market, which affects inventory. So there's a lot in it. And you and I have a mutual friend in the real estate business. And what did he tell us about the number of realtors who actually have dropped out of the market? It was a staggering number.
Yeah. So, since its peak in 2022, the National Association of Realtor memberships fell between 160,000 and 200,000. So that's people kind of excusing themselves from the real estate industry. So realtors, finding new careers.
Well, and this affects other things like mortgage brokers and all kinds of things. So it's a very interesting thing. And I don't know, if I had my wish list, it's a difficult one for me personally to make a call as to how these things would impact one another. It's a lot. And again, I just emphasize I think people feel like right now when there's uncertainty that the best place for them to be is in cash, but cash rarely rewards a long-term investor. And I think that's where we have to keep our eyes is on the long-term, not the short-term fixes that you talked about earlier.
Sure. And Brian, when we talk about real estate, I mean, we're, many times we're talking about, homes, like personal homes. And, I remember Randy always saying, a home's not an investment, it's an expense. And I've got a lot of those coming up, painting, flooring, windows, all that stuff, right? But, when we do think about real estate as an investment in an asset class, what are your views of real estate today?
Yeah, well, I think going back to something Randy said earlier that's really important, which is, there are benefits to inflation from an investor's perspective, right? There are opportunities to generate a higher return. And if you think about Randy's 18% mortgage, there was somebody on the other side of that receiving 18% interest. And so as an investor, higher interest rates are a good thing because it allows us to generate more income in our portfolios. But, I think as you were talking about residential real estate, I think you made some great points about the fact that inventories are rising, and it's different. Residential real estate's a very localized sort of market. In some parts of the country, inventories are rising. In others, they remain pretty tight. But I agree with what you said earlier that we're moving into a period where buyers might be in a better situation. But I think about, Randy said 18%. My first mortgage was 11. And the other side of that is, you obviously can't afford as much house when you're paying 11% interest. And so I think thinking about where the demand is and the part of the market from a demographic perspective in terms of who's trying to enter the market and how much can they afford with, mortgage rates in the mid sixes is important. When you think about commercial real estate, post-COVID, there was a lot of commercial real estate that had a really tough time. If you think about office space in particular, other parts of the market, though, the commercial real estate market are doing extremely well. So industrial is a great example where you see a lot of manufacturing being reshored or brought back to the United States, which is great for that market and creates a lot of investment opportunities. Same thing in logistics. If you think about all of the storage facilities that you see for whether it's residential or commercial, those facilities are generally part of a real estate investment trust or some type of commercial real estate investment opportunity for investors. And so this kind of market presents a great opportunity, I think, for investors when you think about where we are today relative to where we were several years ago.
Yeah, I would also add to that. I think that's a great observation. The importance of diversification. I think really the fact that different kinds of assets and different asset classes tend to change theme. There seems to be a rotation. Growth being the dominant thing that we've seen for the last couple of years. And then we look this year, emerging markets, small cap stocks, international value, all of them played a part in a good portfolio. And, you don't have to put everything in the winner. A matter of fact, diversification means that you did have a loser in the mix. But or you're not really diversified. But it really, this year has rewarded effective diversification, which I know Brian also is a big believer in. I mean, diversification may be the only free lunch out there, but things like commercial real estate in general, and I just want to make one comment. Your home is an expense. I think real estate can be a great investment, but your home is an expense. That's what.
Yeah.
Add a little clarity.
And I've been, I know you've been a real estate investor longer than I have, but I've been investing in real estate since 2005. I've had long-term rentals. Today I've got short-term rentals. So I'm even in my own portfolio, I have real estate exposure. And trends. I mean, there are trends. There are rotations that you can see in the real estate market. And one of those things that I would even glean from today. I mean, the hottest thing that's talked about all over the news, everywhere you look, it's Wall Street Journal, everything. It's data centers, and so
I don't think we could talk about that.
But with the rise of AI, the need for energy, all these things, I mean, we're seeing more and more there. And, that's obviously not a recommendation to go invest in something that is, exposed to data centers. But the point being here, as Brian was alluding to, there was a period of time where you wanted that headquarters, that safe haven, that office space. There's those times where warehouses come alive, the big boom with Amazon, back in the day. And now we're looking at, so there is going to be that cyclical, but what you really, in my opinion, need is that expert that really understands the market. They understand, the different avenues of investing in real estate, but also, large cap, small cap, et cetera. I mean, you want an expert involved.
Absolutely. And I'd be very interested in hearing Brian maybe address the sidekick to that is the cost of energy. One of the big criticisms about data centers in that is energy costs in that. And I'm just wondering, Brian, what you see energy's playing into the economy and maybe what it does to assets.
Yeah, it's a great point. And look at it from two perspectives. So look at it from an investor's perspective, and the energy sector of the stock market is one of the best performing sectors this year. And not just because of what's happened with the price of oil and natural gas, but in part because of what you were just saying about the need for energy associated with data centers. If you look at the amount of energy that a data center uses, it's a tremendous amount. And so people have a right to be, I think, concerned about an increase in demand in their local market from that data center causing prices to go up. But what we're starting to see is the idea that, I'll give you an example. I was at an investor conference yesterday on artificial intelligence, and they were talking about co-locating data centers within properties that were either former or current steel mills. Reason being is that the production of steel requires a tremendous amount of energy. So you have real estate that's open, and you also have a power infrastructure that may need some repair, but is already in place. So there are ideas, I think, that are out there and investment opportunities as a result of those ideas to try to figure out how not to have the increase in data center power need force consumers to pay a higher price for energy. But regardless, I think we'll see an increase in energy production. So if you think about what people used to think about as sleepy utility investments, buying a power company, that used to be viewed as sort of an income producing type of a stock. And now, if you think about it, a lot of those are actually growth stocks because of the need for that energy infrastructure. So I think whenever you think about potential issue like that, think about how it's being resolved, where the innovation is taking place, and then that's an opportunity to look for investments.
Yeah, and I love your framing around that because you can find opportunity. Like opportunity is out there, and there are some brilliant minds working out this, and we've got to pay attention. At the end of the day, we have to pay attention. And pivoting a little bit on energy, I mean, we were just talking about how energy rose in cost from an inflation standpoint, 14.7% when it was measured in July. I'm about tired, as I think the rest of the world is, of hearing about the Strait of Hormuz and this Middle East conflict. I mean, we're getting kind of tired about this, but it's not going away. It's still a real problem. While the EIA is expecting Brent crude to end up around $85 per barrel in the third quarter, and maybe even falling by the end of the year to a normalized rate of $78. We keep seeing these every time there's another missile, another bomb, another thing. We're seeing some small hikes and then normalization, small spikes, and then more normalization. But I think the story that I'm a little bit concerned about even more, if either of you have thoughts on this, is I'm concerned about where our diesel supply is. I'm concerned about petroleum supply. They are running at, we haven't seen lows like this since going back to the 80s. And so I don't understand why we're not producing the way that we have historically produced to keep those supply levels up. But, diesel impacts everything. Getting from the ports to the warehouse to Walmart, So any observations or thoughts about energy today?
Yeah, a couple things.
Who wants that one? Who wants that one? Calm down, guys. Calm down.
Let me start with the Strait of Hormuz comment, because I think it goes back to this idea of innovation. So it's interesting if you look at the amount of oil that came through the Strait of Hormuz, it's down about 17.5 million barrels per day.
Wow.
If you look at the real difference in the amount of oil and natural gas coming out of that area, it's actually closer to 3 million barrels per day. Why? Because Saudi Arabia, as an example, is using pipelines across Saudi Arabia to ship through the Red Sea instead of through the Strait. You made this a great point. You've seen many countries draw down their reserves to replace what's not coming through the Strait. So at least on a year-to-date basis, one of the reasons oil isn't trading at $150 a barrel is because there are ways that people have found to offset what's not coming through the Strait. And that will continue. But I think the point you made about diesel is great, because when you look at what's happened in the U.S. production of oil and natural gas is at the highest level it's ever been. And one of the things that we benefit from in the United States is that we're really energy independent. We produce enough oil and natural gas to basically run the economy. The challenge is that you have to be able to get it refined into something like diesel, and refining capacity is a problem here. And that's why when you see in the Iran-U.S. war attacks on energy infrastructure, people get so concerned about the long-term perspective on what that means for energy prices, because getting it out of the ground is one thing, getting it refined into the products that we use is another. And so that lack of refining capacity in the U.S. Is something that we've got to work on. The permitting process to get a refinery open and then online is extremely long, more than a decade.
Wow.
So it's not something that you can quickly repair. But certainly what something like this war does is it presents perspective for people to say, maybe that doesn't make sense. How can we be energy independent in terms of being able to produce oil and natural gas and not refine enough to resupply our stocks and to get enough into the market. So I think you're starting to see investment there. And that's kind of where my mind goes again, is so that means that there's probably an opportunity to make investments around the infrastructure that will need to get built out to meet that demand.
Well, and I really like how you position that, because everyone's talking about, supply, but you're pivoting and going, hey, actually, maybe not the supply is the problem. Maybe it's really the ability to refine it, which I think I'm not hearing really anyone talk about that. It's just, hey, if we've got so much of it, this shouldn't be a problem, but we are experiencing a problem because of the lack of the ability to refine what we need to. So I think that's a great observation.
Yeah.
Right.
Yeah.
And we've had several instances where we've had either accidents or fires that have taken refining capacity offline. And, you read that story and you think, oh, well, that's not a big deal. But, you take 3 or 4% of refining capacity offline and then have a situation like we have with this conflict with Iran, and all of a sudden that 3 or 4% becomes a very big deal. So, but I think you'll continue to see investment in that refining capacity and the government, I think, has made some efforts to improve the permitting process so that it doesn't take so long to bring that capacity online.
Yeah, well, and I think we've certainly seen a pivot with our Department of Energy towards trying to adjust some of the regulations that has hindered some of the growth, and we're seeing more and more pivoting away from things like wind, solar, et cetera, because the reality is we still do need our natural resources. We still need the fossil fuels today, and not meant to be political or anything else. It's just observation for the infrastructure we have today.
Yeah, and I think one of the things these kind of problems present is the innovative nature of the United States, because we really we take a problem and we create opportunity out of it. Much of the world is, much of the success of our economy over the last 100 years has been innovation, and struggles like this create that. I don't want to get into a big, long conversation. I know we don't have a lot of time, but it makes me rethink nuclear power and how there seems to be a lot of concerns that are probably unjustified about using it, and how that might be coming more and more into play too. And we really need to look at all the options for our energy production. Anyway, it'll be interesting to see how all of that plays out.
That's actually a great example of the way you tied together innovation and the idea of using nuclear power for data centers as an example. The Navy has used nuclear power for submarines and ships since the 50s without an accident. And so being able to build a nuclear generator the size of something that would be used on a sub would be enough to power a data center. Wow. And there are some companies that are evaluating that and trying to figure out if it's something that can be done at scale. Which again presents, an opportunity. But you have seen an increase in renewables. I think the point you made earlier, though, Nick, is just that there's sort of a mismatch between how fast renewables can grow and the need that we have, which is why we continue to need more refining capacity.
Yeah. Yeah. Well, and hopefully the folks at Washington, they're tuning in, because we're solving all of their problems right now.
We covered it all.
Do they call you? They don't call me, but they should probably call us.
They're listening to you through your phone and Alexa.
Yeah, that's right. Facebook.
If there's anything good, they're getting it.
That's right. I don't have a cat. Why am I getting all these ads for cat food? Oh yeah, my neighbor got a new kitten. I'm like, it's crazy. All right, so in this world where we do have chaos, we have confusion, we have upsettedness, around our country, and we've got some division, we've got elections coming up, we've got all this stuff. And, my encouragement to our audience today, turn off the news, right? Give yourself a break. because I promise you there are more of us that are looking to be together, looking to be good friends, good neighbors, regardless of the nuances of our beliefs. We still care about each other. So sometimes we just got to turn that TV off. But I'm going to butcher a Warren Buffett quote, okay? And this is me making it my own. But basically, when people get fearful, I get greedy. And when people get greedy, I get fearful. And, what I want to pivot towards is, where do we see opportunity in the midst of, global conflicts? Ukraine, Russia, Southeast Asia, China, Venezuela. Are we going to invade Cuba? Like all this stuff, right? Iran. You got all of this stuff in our head and from our face. Even in the midst of all the clutter and all the chaos, there seems to be opportunity. So, Brian, where do you see opportunity in the marketplace today?
Yeah. First of all, I think it's great that you bring that up, because that is the way to think about what's happening. Certainly, we all have concerns about a lot of the bad news that we receive every day, but the news isn't news if all it is good news, right? Because nobody would watch, unfortunately. So, but the way I think about it, just to kind of walk back through our conversation, if we start with interest rates are higher than they were several years ago. And so as a result, if you're an income investor, there's an opportunity from a fixed income perspective to just generate more income because bond yields are higher. So I think there's
Brian, bonds aren't sexy and cool. Like, no one talks about bonds anymore. Those aren't fun.
No, they're not sexy and cool, but when you can start to get a 6 to 7% return in bonds, which has not been the case for decades, then all of a sudden they become cool again. So I think we're entering a time where maybe bonds are cool again. So I think that's the first thing. The second thing we talked about was real estate, and in particular in commercial real estate. I think there are some great opportunities to think about. And a good example is if you look at on the commercial real estate side, I mentioned that sort of reshoring of manufacturing. That's a long-term theme that will continue to benefit industrial real estate. The fact that a lot of manufacturers will, rather than own land and the building that they're going to manufacture in, they would rather lease it. And so there are real estate organizations that will acquire land and then build on it and then lease that out to a manufacturer. So I think that continues to be a great opportunity. And in real estate in general, this is in pockets, but I think even office space in certain markets is starting to come back. So definitely opportunities in the real estate market to generate some decent returns. Randy mentioned something earlier too that I think is interesting this year, which is that small cap stocks have started to do better this year. And if you think about it, there's a couple reasons for that. One, the tax bill that was passed last year allows all companies, but small companies benefit in particular because it allows them to depreciate the expense of a new machine, as an example, more quickly. And that helps them from an earnings perspective. In addition to that, while we would argue that maybe rates are elevated from where they were a few years ago, companies have adjusted to that, and the availability of capital for small companies to innovate and invest in this AI theme has really been significant. So you're starting to see small cap stocks do better, and they haven't for a long time. So that's probably also a theme that lasts for a while. And then we talked about energy, and I think in the energy space, whether it's energy infrastructure, like that refining capacity that we talked about, or this idea that you will see production move from one place to another differently. So I mentioned Saudi Arabia as an example, using pipelines to get oil across the country to have it exit ports that are on the other side of the country. Well, that means that someone has to build that infrastructure, and you'll start to see that. So there are global companies that do that will be benefit from an investment perspective. So I think there's a lot to worry about. That's my job, but there's a lot of opportunity when you think about these kind of themes that we've touched on today.
Yeah, no, I think those are some great observations. I mean, so many times, energy's, a dirty word when you have to fill up your gas tank at the pump. But if you're looking at it from an opportunistic standpoint, I mean, there's so many ways that plays. But even from a consumer standpoint, I've shared this story before. People thought I was crazy. Brian, years and years ago, gas prices were through the roof, and I did something that people thought I was crazy. Now, I am a little, but I went and there was a car that was sitting on a car lot, and it wasn't moving like for a couple of months. Okay. It was still there, and it was a bright red, shiny Hummer. Okay. And I named her Lucille after I love Lucy. All right. She was my redhead. All right. And, here's the thing. I ended up negotiating something like $12,000 off that car. Okay.
Yeah.
And at that time, people were paying thousands and thousands of dollars over MSRP for the new thing, the Toyota Prius. Right? Everyone wanted the Prius because gas prices were so high, so they were paying premiums to save gas. And I thought to myself, how much gas could I buy with $12,000? Sometimes we got to pivot and think just maybe a little bit different. And I thought about, Chevron and all these other energy companies I had in my portfolio, and they're making record profits at the time. And I thought, I'm making money. So every time I'm filling up, I don't necessarily like it, but I'm still thinking I'm getting a return right now. Right?
Exactly.
So we got to pivot. Right. So Randy, again, I'm going to follow up, just as I asked Brian, like, where are you seeing opportunity today?
Well, I don't think we get rewarded for predicting the future. So I think one of the things that I think about is really the capital that we make, the amount of money that we keep, the profits that we make, have a combination of doing good tax planning, how we invest with a tax awareness. I think that is still the opportunity today. Rates are low, making smart decisions with regard to things like Roth conversions, using QCDs. So it's really not always just what asset class. So we don't really get rewarded for predicting the future. And I think the other thing I would have our viewers leave with is diversification is a key to long-term success. And that means you can't brag about having all your money in the sexy, like you were talking about, the best thing. But you get rewarded when things shift, and things do shift. And so, if you look throughout history rarely repeats itself. But there are themes that seem to be in common. And you were using the, an adaptation of Warren Buffett. I think that's still true. That you can't let emotions dictate how you invest money. I think you put together a prudent plan. The rarest thing that people do is stick to the plan. That's why we have a job today, because we need to have discipline in how we manage money, and that removes the emotion. And you said shut the TV off. The point is, don't let your gut, investing is, in my mind, counterintuitive, which means your gut is wrong. The masses are usually wrong. What's prudent is a well-diversified portfolio that doesn't try to predict the future, but maybe makes theme changes. We reconsider things that are shifting, like energy, real estate. We re-employ these long-term consistent principles of prudent investing. I think that's the opportunity.
Well, and I like that because, while we could certainly look at themes where, we're looking at momentum, relative strength, relative value, we can look at the technical indicators out there, and we could make, some judgments as to what maybe the asset class of the day is, or the sector, when we look at the sectors of our, U.S. economy. But, planning still has a place for opportunity. I 100% agree with this, but you did bring up a word that I'm going to toss it up to either you or Brian, who wants to take it. It's, I didn't send this to you as a bullet point, but, it's your fault, Randy. You brought it up. A lot of people hear the word diversification, but when they come into our office and we look at what they have, we find out that they're actually not diversified. They've got the XYZ fund, the ABC fund, they've got this ETF, et cetera. You look at it, and 30% of their portfolio is in NVIDIA, Apple, Meta, right? And it's because of, cap weighting in the S&P 500, et cetera. So what does actual good diversification, and I don't think we should necessarily try to own everything. I think there does, my personal belief is that intentionally just owning losers that, don't have strength, they have excess risk, et cetera, that's not the kind of diversification we're talking about. Having real diversification might be something different than a lot of the investors and a lot of the people in our audience today are hearing, because it's not just owning the black one and the red one, because when you open it up, they look almost identical. So if we were to talk about proper diversification today, what does that actually look like? All right.
Brian, we lost
I was waiting for Randy to jump in there. So the one thing I would say that's really important about diversification and the benefit of working with an advisor is that if you just use bonds and stocks, right, the reason that people own both in a diversified portfolio is because they generally don't perform the same way at the same time. But what's important, I think, is that that relationship between those two assets changes over time. Yeah. And so one of the benefits of working with an advisor is they're going to understand the plan, understand how diversified you are, and be able to actually measure if that diversification is benefit is changing over time. And that's something, to your point, maybe when you look at a portfolio that somebody brings in, they haven't looked at that because maybe they don't have the tools that we have to do that. Yeah. But I think Randy's point about being diversified is really important. And all diversification is, if you do your financial plan and it says you need a 7% return, there's a certain group of assets that will produce a 7% return. And then we just kind of work through the diversification process to say, can we get the volatility of that 7% return as low as possible? And the mix of things that we put together hopefully reduces that, so that I'm going to generate 7% over time, but it's 7% plus or minus 6% as an example versus 7% plus or minus 12 in a given year. And so I think that idea of diversification is super important, but that's really all it is, right? We're just trying to create a less bumpy ride over time. And especially if you're at a point in time where you're beginning to think about drawing on those funds in retirement, the less bumpy the ride, the more comfortable you are. And that's kind of the idea behind diversification.
Oh, that was spot on, 100%. So Randy, I think one of the challenges when you look at that, maybe that equity side of the portfolio is, sometimes people do have that false sense of confidence. And like Brian's saying, the importance of having that coach or that advisor in your corner is that you've got somebody that is actually able to peel off the pieces to help you really add some clarity. Right. And I know you've been in this, this game a long time.
Hey,
a really long time. From a general education perspective, if you were to coach up our audience today, what might be one or two things, if they were to think about diversification today, that might keep them from maybe making a mistake or having a false sense of security?
Yeah, I think creating their own investment policy that, like Brian said, if you're after a 7% return, what are the mix of assets over the time frame that you're going to want that? But I think what we see when we bring on a new client often is more like what you indicated, recency, which says what's been going on that's been successful today tends to load up in their portfolio, which means they could have, like you said, several stocks and several funds, and basically they're duplicating everything. They aren't really diversified. They got different colors, different names, et cetera. But, owning small caps like we saw with a certain percentage, owning international, owning some emerging market, owning different kinds of fixed income, along with your growth or blended U.S. equity portfolio, means that when the U.S. market's on an all-time run, you're going to have a tracking error to that index, and you can't be blown away, because if you look at U.S. equities and you're just in the S&P 500, we've seen several times where the drawdown and that's been over 50%, which would be a great time to, deploy Warren Buffett's philosophy. But if you don't have fixed income or diversification, you can't even buy when an asset class is down. So I also think that one of the themes our office uses that have been very prudent and worked well for us is that we manage retirement accounts and non-retirement accounts differently, which means I think that your non-retirement accounts need to be all weather in nature, meaning more effectively diversified than maybe an IRA where you could afford to make changes without tax considerations. So really having a plan, putting the plan together, it doesn't have to be sexy. It has to take into consideration that this too shall pass. You've heard me say this 100 times, but there are seasons in the economy, just like there's seasons in life. Think more like a farmer and plan for what's coming prudently. Don't predict it. Plan that the seasons will change and have your portfolio set up to do that.
Yeah. Awesome. You know, I'm going to leave with two opportunities that I see today. And one is for the entrepreneur. So if you're an entrepreneur and you're looking to get into business, you're looking at investing into a company, creating a company. I think from a tax policy standpoint today, I don't know the last time there was a better time. And, looking at what technology brings us, the ease of getting into business, starting a business, even starting an LLC. I think that the America that we have today was birthed and really blossomed because of people willing to take a risk on themselves. They were willing to pay a price. They were willing to sacrifice. So I want to encourage the entrepreneur out there. While there is a lot of difficulty is often, success is oftentimes difficulty mixed with what? Opportunity. The second thing is, if you are considering buying, work with a couple of, if you're looking at buying a home, don't be too discouraged and downtrodden by where interest rates are. I do think we're on the verge of seeing more of that. We aren't there yet, but we're almost at that true buyer's market where you do have a little bit more power to negotiate. So you might have a higher interest rate, but if you can negotiate another $50,000, $60,000 off the purchase price of the home, might be worth it. So again, look at all of the math, not just the interest rate. I think that's where some people are keeping themselves from improving their situation with real estate. So I do think there's opportunities in real estate, but work with that professional to help guide you through that process. With that said, for our audience today, I hope you've enjoyed the conversation. I've so enjoyed hitting on these bullet points, but also hearing from our special guest, Mr. Brian Andrews. Brian, thank you so much for joining us today.
Thank you very much. I appreciate it.
Yeah.
It's great to be here.
And so for our audience, we have a few more sessions of Coffee Break coming up for the remainder of the year. We've got one coming up in September and in October, and we've asked Brian to join us again. Brian, if you don't know, he is just a wealth of knowledge, and as a part of now Team Merit, we get the awesome opportunity to leverage awesome people that are bringing immense amounts of expertise to the table, and we believe that an educated client is our best client, period. And what Brian is doing and what he has agreed to do for our clients is to start sending monthly economic update videos. Here's what's going on. Here's what to pay attention to. And he's helping our clients cut through all the chatter, all the noise of what's going on in the world around us, from the talking heads on, whatever the flavor of news is that you watch. Let's get rid of that and just get to the facts. Here's what to pay attention to. So we're so grateful to Brian to be able to put out that. So if you're a client today, you're going to be receiving an email on a monthly basis with a video of Brian saying, hey, here's what's going on. Here's what we want you to pay attention to, etc. And it's really great content. So Brian, I'm looking forward to getting that in our clients' hands.
Absolutely. And I think it'll be coming out soon. So
yeah, awesome. Randy, as always, thanks again for being the coach behind the clipboard. This is always fun.
I enjoyed it. Thank you, Brian.
Yep.
Thank you.
And for our audience today, please continue to check out all of our social media. We are trying to keep you informed. This is a changing world. Lots of stuff going on today. We want to empower you to make really important decisions that do impact your retirement, your financial future. Thanks for joining us today, and thanks for staying coachable.
We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@meritfa.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. Investment advice offered through Merit Financial Group, LLC, a registered investment advisor.